M&A waves. The domestic volume and value of M&As tend to display periods of surging growth only to later recede. European waves follow those in the United States with a lag. Cross-border deals tend to follow cyclical patterns similar to domestic merger waves. Understanding M&A waves can help buyers and sellers properly time and structure their deals. Why do M&A waves occur? U.S. M&As have clustered in multi-year waves since the late 1890s. One explanation is that merger waves occur when firms react to industry shocks, such as from deregulation, new technologies, distribution channels, substitute products, or unpredictable events such as the 2020 global pandemic. Another explanation is based on misvaluation and suggests that managers use overvalued stock to buy the assets of lower-valued firms. For M&As to cluster in waves, goes the theory. Valuations of many firms must increase at the same time. Managers whose stocks are believed to be overvalued move concurrently to acquire firms whose stock prices are valued less. For this theory to be correct, the method of payment would have to be stock. In fact, the empirical evidence shows that less stock is used to finance takeovers during merger waves. Because M&A waves typically correspond to an improving economy, managers confident about their stock's future appreciation are more inclined to use debt to finance takeovers because they believe their shares are currently undervalued. Thus, the shock argument seems to explain M&A waves better than the misvaluation theory. Domestic merger waves. M&As commonly occur during periods of sustained high rates of economic growth, low or falling interest rates, and a rising stock market. Historically, each merger wave has differed in terms of a specific development, for example, a new technology industry focus, for example, rail or oil, deregulation, and type of deal, for example, horizontal, vertical, conglomerate, strategic, or financial. Firms pursuing attractive deals early pay lower prices for targets than followers. Late in the cycle, purchase prices escalate as more bidders enter the takeover market, leading many buyers to overpay. Reflecting this herd mentality, deals completed late in M&A waves tend to show lower acquirer returns than those announced before an upsurge in deal activity and are less likely to be completed. Another reason deals undertaken late in the cycle underperform is that monetary policy is generally tightening, resulting in higher post-acquisition financing costs and less shareholder wealth creation. Cross-border merger waves. Similar to domestic mergers, cross-border mergers cluster by industry and by time period. Both are triggered by similar factors, but unlike domestic M&A waves, deals completed later in the cross-border cycle show higher acquirer financial returns. Also, returns tend to be much higher than deals completed outside of waves. Post-merger operating performance is also better for within-wave cross-border deals. This superior performance is even greater if the target country is different from the acquirer's country in terms of culture, economic development, geographic location, capital market maturity, and legal system. The superior performance of cross-border acquirers doing deals later in the cycle may reflect their ability to learn from prior deals made in the target country. Earlier deals establish comparable transaction values that may be used for valuation of the target firm, thereby limiting the acquirer's risk of overpaying. If in these prior deals investors have rewarded acquirers by bidding up their share prices, investors are more likely to applaud similar future deals as long as the acquirer does not overpay. Empirical evidence supports this notion in that firms are more, less, likely to undertake cross-border deals in the same country if they observe positive, negative, stock price reactions to previous comparable deals. The impact of the 2020 coronavirus pandemic on M&As. The immediate impact was that deal terms on completed deals often included holding back a portion of the purchase price. Lengthy due diligence became the norm, financing for large deals dried up, share exchanges became more common, and many negotiated deals did not get done. For example, aerospace and industrial components manufacturers Woodward Inc. and Hexcel Corp. mutually agreed to cancel their merger announced in early 2020, citing the need to focus on their core operations. And bankruptcies nearly doubled, concentrated in the mining, oil and gas, and retail sectors. LBOs waned early in the year as private equity firms focused on nursing their portfolio of businesses through the pandemic-induced recession. However, sitting on a cash hoard of $2.7 trillion according to data provider Preqin, buyout firms renewed their pursuit of buying assets at distressed prices using funds borrowed at record low interest rates by year-end. Strategic buyers that did undertake M&A pursued targets in COVID-resistant sectors, such as technology and healthcare. The longer-term impact depends on the pace and sustainability of the global economic recovery and the resiliency of world trade and capital markets. Restrictions are likely to make capital and labor flow across national borders more difficult. Regulators worldwide will tighten rules for foreign investments to protect national assets viewed as critical to domestic security. And countries will become more self-sufficient in the production of items considered in the national interest, such as medical equipment and supplies. Supply chains will look far different from what they are today as businesses diversify sourcing. The net effect of these factors could be to reduce the number of cross-border deals and increase interest in domestic firms. Thank you for your listening.